Hello, this is Jan Loijs on 26th of November. Well, another week is a bit hard, sliding a riskier market. Didn't benefit government bonds much, as worries about credit quality at sovereigns is part of the problem. We've got a few more weeks left to go for the year. Investors made good money on most asset classes. There's a bit of uncertainty around, so we'll probably see a bit more position squaring, just trend reversals in coming weeks. But let's think a bit further into early next year. Over that horizon, we're confident that riskier markets, the bullish forces for riskier markets, will be stronger, will offset some of the bearish uncertainties out there. These bullish forces simply in price momentum, value riskier markets, and also economic momentum. Data have been consistently surprising on the upside in the past 5-6 weeks. And we've raised significantly the second half growth forecast for the world. We've only raised next year a little bit. We're still waiting for some clarification on fiscal actions early next year. If it wasn't for that, we'd be raising them now already. The bearish forces, uncertainties around Chinese tightening and monetary union, sovereign credit pressures, they're a bit like brush fires, local problems. Initially, you just skirt them, you underweight these areas. Because in the beginning, you just don't know whether they'll become a wildfire. You reduce risk a bit, but as you appreciate their local nature over time, you add risk again. That's what we think will be the case for Chinese tightening. It's a bit less confident this is the case for monetary union. At the core, monetary union is unstable. The last few decades, Europe has made massive progress on economic and monetary unification, but not much so on the fiscal and political side. And unfortunately, you need both. So Europe has to decide now. Does it use the crisis, that moment, to build the institutions that you need for somewhat joint management of fiscal policy and funding? Or do we continue to slide towards maybe a smaller region or disintegration? There's a few implications for us on markets, more medium-term ones. First, this uncertainty about Europe will not be resolved soon, so euro and EMU stability will remain with us for next year. Second, I think the cat is out of the bag on the default-free nature of developed market governments. We now know that they could default. So I think this is going to spread to other countries, and particular governments that need to borrow from abroad will now be judged more and more on credit quality. Third implication is that there's an almost safe haven flight towards emerging markets debt, on the idea that the developed markets now have too much debt, are subject to default risk, and suddenly overnight emerging markets are perfect. Clearly this is already creating some form of a bubble that could burst over the next year. And fourth, corporates. It's not unfetched that over the next year, maybe later, the large corporates, multinationals in particular, will be able to borrow less at a lower rate than the sovereign. It used to be the sovereign was the lowest cost of borrowing, and corporates would always have to pay a risk premium over them. That's not the case anymore. The sovereign can't just grab the corporate anymore, particularly when they're multinational, or when the sovereign itself, like a monetary union, has less sovereignty. So, as a result, I think we should anticipate a time when corporates will be borrowing more cheaply than the sovereign. I thank you.